G'day, Chris.
Good afternoon, Cameron. How are you?
I'm really well, mate. I'm really well. So your
Good.
work from home day today?
Yes, I've got my youngest has been ill for the last 4 weeks. So I think we've had 6 weeks of daycare, and he has been home for 4 of the 6 weeks. So yeah, as someone said to me, the juggle is real. So we're enjoying the fruits of paying to have our child build his immune system.
Oh, the poor thing.
It's all right.
Yeah,
It's fine.
one of those times.
Yeah, that's it. It's only for a small season.
Very good. So coming up 30th of June here, it's been a busy month, financial planning wise and in accounting land. But we're also here to talk about markets. So we thought we would give the June update. The monthly market and economic update. So there's been a little bit happening over the course of the last month. And I know I've been chatting to a few clients about the continued volatility, but also upward trend in financial markets, which we continue to see. And it looks like this year is actually going to be a pretty strong year for super fund returns, if you like, and also for investment market returns.
Absolutely, especially coming middle of last year was almost the lows after the invasion of Ukraine and subsequent inflation concerns. So the numbers are going to look spectacular for this financial year, relatively to the last couple of years. Anyway,
that's right. So, all right, let's get into it. So, I guess the first thing where we always typically start is GDP growth, and this chart is showing us GDP growth for the world. Again, we haven't got updated numbers here because we're waiting for these numbers at the end of June, but essentially we're still seeing GDP growth at a reasonable level for the world. So I guess that's probably looking okay for the time being. In terms of Australia, we tried to isolate this a little bit further. So we've seen a slowing of GDP growth, which is really off the back of coming out of COVID, Chris. So we had, obviously that was that July quarter of 2020, which was a very significant negative reduction in -6.7. And then the big bounce back, and then slowing again, then a reduction, and then a bounce back. But really, since probably 2022, and then it had been consistent quarters of around about that 0.6. And now we were looking at 0.2 last quarter. So the big question on everyone's lips is: are we going to be seeing a recession in Australia as a result of what has been very significant increases in interest rates and obviously inflation as well?
Yeah, it's interesting, isn't it? I think anecdotally everyone feels like it's coming, but I guess we'll wait until the data arrives.
Yeah, that's right. But again, when you annualize those numbers, we're still at GDP growth. It's sitting, at around about 3 to 4% at the moment. So it's still okay, but it'll be very interesting to see what this last quarter has been, which we'll get next month. CPI inflation numbers. So again, in Australia, we're seeing inflation starting to turn around. So we had some numbers at the end of the last quarter, 26.4, which was 6.6. So yeah, it's starting to pull back on the back of increasing interest rates. Any thoughts around that, mate?
Yeah, I think I guess the few things that I've been reading over the last sort of few days since that number's come in is the headline number looks good in terms of we're coming down, but the core inflation number is still something of a concern. No, I'm not sure if those the core numbers are in here, but it is nice to see that. Well, we hope anyway that it's peaked. It's just going to be a question, as we've talked about over the last few monthly updates, is what's the pace of the decrease? Are we looking at 18 months, which I guess was what we or what the general market consensus was, say, I don't know, at the turn of the year, whereas I think it's looking increasingly likely that it's going to be a significantly longer period. Again, we're crystal balling here, but yeah, I am hoping that we've seen the peak of it.
I mean, look, it's clearly very difficult, and markets are trying to work that out at the moment. But importantly, we have seen inflation numbers start to fall off, not just in Australia but also around the rest of the world, which is almost what this points to. So what we've got here is April 23 data, and then we've now got the updated June 23 data. So particularly in Europe, we had Europe hit a peak and then started to fall off. So this is to April 23. Just tick under 9. That's continued to fall. So we're looking at inflation data in Europe, which is still pretty high, just a tick above 6, but it's continuing to fall, which is clearly nice to see. The US, again, pretty similar. So it was a tick above 6. Now it's fallen a bit further than that in the updated data. So we're sitting at around 5s. And then obviously Japan. So Japan couldn't inflate their economy forever and took a COVID crisis for that to occur, and it's inflating. So got to around about 4-ish, and it's pulling back as well. So I guess that's important, right? And that's also why the markets are, financial markets, equity markets, bond markets, are looking at this data going, yes, we've hit peak inflation. Yes, we're in a good position. It's a good time to be buying stocks. And we continue to see the market rise, particularly in the US. So it's important I think to note, to see that we have seen inflation start to fall around the world. And Australia, the data in Australia has always been sort of a bit behind what we've seen in the rest of the world, because the RBA was a slightly slower to move.
Yep.
In terms of jacking up rates.
Yep.
One of the things that I suppose plays into what happens with inflation is wage price growth. And again, we're comparing April 23 data with June 23 data. So we've continued to see wage prices increase. I won't say spiral, because they're not spiraling, but we have continued to see them increase in terms of the average pay. And this data has come out of the ABS, Australian Bureau of Statistics. So, I think Shane often puts it best when he says, well, you don't begrudge anyone getting a pay rise, and particularly, when the Fair Work Commission came out and said minimum rates to go up by, was it 5? I think it was 5, wasn't it?
Yep.
It's hard to see how that would be inflationary, but we don't want to see a wage price spiral. So
no, absolutely not.
Yeah.
And I think these charts are, I guess, what the RBA and the Fed definitely as well are concerned about, that these charts do turn into that. So that is one of the reasons why, if you think of what the Fed's coming out with, I was going to say jawboning, but it's a technical term in terms of talking about that they're likely to leave rates higher for longer, because they don't want to be the Federal Reserve that did. I can't remember the name of who was the head of the Reserve Bank in the 70s, where started to see inflation come down and took their foot off the interest rate pedal, and then inflation turned the other way. And so it's the concern for reserve banks around the world is, although they're trying to kill this this phenomenon, I guess, to ensure that there is no wage price spiral.
Yes, so it's interesting, isn't it? Because if they leave rates too high for too long, we enter recessionary territory. And I just wondering out loud, and maybe we can have a chat about it, but wondering out loud, what's worse for financial markets? Is a shallow recession where they leave rates too high for too long, and we in Australia, we get a recession as a result of that, because no one's spending because they can't, and we have a shallow recession, versus they take the foot off the pedal, so to speak, and these numbers where we've seen inflation data falling, maybe they start to flatten out and even start to increase again. I suspect that we would see, that being the case, we would see financial markets, equity markets, bond markets be quite unnerved by that, as compared to what is going to be likely be a shallow recession if they keep the foot on the pedal for too long.
Yeah, correct. Well, I guess it's all the equity markets or financial markets are always looking forward looking, and what are the risks. So
Yeah.
if we're in a shallow recession, if that's what happens, I guess the risk is that it's not a shallow recession, that it's a deep recession.
That's right. That's true.
And then, but I guess the pain in that, if you think of what's the tail risk of that scenario? The pain of a deep recession is obviously felt across the community, but in the context of financial markets, that's something that you can, or that the Reserve Bank and government can control and have some impact on, which is what we obviously saw during COVID. But then if you go the other way, then you've got the risks of the whole system. The tail end risk is the whole system comes undone. That's a greater tail risk, and I suppose that's probably why rate policy is where it is.
Yeah. Speaking of rates policy, nice segue. Interest rates
They're going up.
That's right. Everyone's talking about it. We all know the cash rate in Australia is about 4%. It continues to go higher. Policy interest rates in the US sitting higher than they are in Australia at about €5 below. Japan's still stationary at 0. Yes, that's right. Cash rates are going up, and seen that have an impact. More importantly, in combination thereof, investing in term deposits. I mean, the other day I locked in a term deposit inside one of the platforms that we use, which was 5.6%.
Wow.
Which is just 18 months ago they were below 1.
If you had said to me 18 months ago that I am going to be able to invest in a term deposit at 5.6% in 18 months' time, I would have laughed you out of the room.
Yeah. You also probably would have said that therefore means interest rates have jacked up 300%, which is what they have. And we would have terror in financial markets.
Correct.
As well.
Yeah,
because that's what
absolutely.
you would expect.
And we'd be in the worst recession we've seen in 40 years. Yeah.
That's right. That hasn't happened. So
No.
we'll talk through some of the financial market stuff in a minute. But yeah, I think it is that part is fascinating. Yeah, interest rates are expensive. So if you have a look at the owner occupier, the yellow line, I reckon I might call that yellow, is just interest only. That sits a tick above 6.5, and principal and interest rates, which fell, almost to, as we know, just below 2%, now sitting just a little bit below 5. So that's owner occupier. Investor loans, interest only on investor loans is actually quite interesting. Below that of owner occupiers. So it's a 300% increase in interest rates, and it's significant. It's also seen that in business lending rates as well, right? So we've seen as small businesses, medium-sized businesses, and larger businesses all had an increase in costs, increase in funding costs and interest costs. So deals, if they're doing a merger, acquisition, or building out or in growth phases, they have to look that much better than they did 2 years ago. 18 months ago, because the cost of capital is so much more. It's 3 times higher. So yeah, that's part of
significantly less money floating around the economy
in the system. Yeah, that's right. Yeah. So, and that's the point. That's the idea, is to slow spending.
Absolutely.
To reduce interest rates, increase interest rates to slow spending. So I know we worked through this last time. Consumer sentiment is the worst it's been, even accounting for 2008, but importantly, that's the consumer side. The NAB business survey, which measures business conditions and confidence, is actually not looking too bad relative to consumer sentiment. So businesses are still feeling, at the moment, still feeling like they're profitable and things are going okay. But importantly, if you think about where that's come from capacity utilization, right? So we've seen that march upwards, which is businesses using their capacity more, using what they've got more to produce more, I guess, right? So
it'd be interesting to overlay those to see whether there's a lag effect of consumer sentiment flowing through to business conditions and business confidence. because you would expect normally, obviously, businesses are selling to consumers that, if sentiment in consumers is falling, then their behaviours change. But there's an effect in terms of how long that flows through towards businesses. So just interesting to if
I
we
haven't got the
ever
data,
had the
but you're
chance
right.
to overlay on that.
I haven't got the data, but you're right. So it'd be great to see the comparison against consumer sentiment and say retail sales as an example, which is always going to be directly impacted by how the consumer feels. Do I have enough money in my bank account to buy X on the weekend or whatever it is that you want to buy? All right. Is there anything else you want to say about the state of the economy?
No, I don't think so, Cam. It's pretty self-evident, I think, where sentiment is and where everybody feels things are, because we're all having these conversations on a daily basis.
Yeah, that's right. All right. So I thought what we could go through now is the portfolios that we run on behalf of clients and the model portfolios that we run. So importantly here, what we're trying to do is just illustrate probably how they have gone in the last 11 months, because this data is only to the end of May, by the way, and June's been a good month too. So just how have they gone in the last 11 months? What's happened? Why have they performed how they've performed? And to your point earlier, Chris, just trying to get an understanding of what's happened in the last 11 months or so, considering how the economics has been and how financial markets doesn't always necessarily closely follow them. So we have a look at the period returns. There's 3 portfolios here that we're showing, and then this is an index. So we might start with 6. Lifestyle Model 6 is a portfolio which is 95% invested in growth assets. Growth assets are Australian shares, international shares, property, infrastructure. And then 5% invested in defensive assets. And the defensive assets are usually things like cash or fixed interest or term deposits. So the 3-month numbers sit here on 6 at 2.5, 6 months at 3.9 or 4%, 11 months. And again, I've just run it as 11 months because we've only got the data to the end of May, showing at 12.45, 3-year numbers 10.64 and 4 years at 8.02. But importantly, if we just have a look for this financial year, we're looking at numbers that are showing what is actually quite a strong return to the end of May and at 12.45%. And markets have continued to rise in June as well. So I'd expect these numbers to be higher by the end of the year, which is in 2 days. So it's good. It's some good returns there. That's fully exposed to growth assets, right? So that's pretty strong.
And it's I think it's a reiteration, I suppose, of the investment philosophy that we are constantly talking to clients about, where the periods where things seem potentially the darkest and there's lots of risk around are usually the periods where investment markets do the complete opposite. And so there's been a lot of conversations that I'm sure a lot of us have had with clients over the last 12 months, where there's been hand wringing about whether we should sell out or like sit out of this type of environment. And these are the periods where you recoup the down periods that we had during 2022. So it's I guess it's a reiteration of why we think the way we do, and I guess another empirical piece of evidence behind it to say that it works, even when it's, I guess, uncomfortable sometimes.
Often uncomfortable. Time in the market, not time in the market.
Correct.
So then if we have a look at 4, Lifestyle Model 4 is 70% allocation to growth assets, again, Australian shares, global shares, property, infrastructure, and then 30% exposure to defensive assets. So you would ordinarily expect the return, the level of risk in that would always typically be lower than what you would see in Lifestyle Model 6. And then subsequently the return you would often see would be lower over the longer term as well. So, and that's sort of what plays out here, right? So the year-to-date returns are showing at 9.6, 3 years 7.39, and 4 years 6. And then we've got Lifestyle Model 3, which is the moderately conservative portfolio, and even something as conservatively invested with 50% in growth assets, 50% defensive assets. That's done 7.7 this year versus the benchmark, which is 4.2. So it's been a good year, good financial year to be investing. Which is not really what you'd expect. And I know I'm having conversations with existing clients about this at the moment who are talking about how they're expecting negative returns when we're doing our reviews. And that's because what they're reading is doom and gloom, inflation, recession, inflation, recession, just those two words over and over. It's actually been quite a strong year.
I think that comes back to your point though earlier, Cam, where the I was going to say the connection rather than using the word correlation, but the correlation between financial conditions and financial markets. I think there's an underlying expectation that they are, very close to each other. That's actually not the case. Not all of the time. Obviously, there's periods, but markets are always more forward-looking rather than where things are today.
Yeah. Absolutely. Might be worth highlighting the drawdown phase. And importantly, what we're trying to do here is say, well, so of the portfolios, there's certain levels of risk in certain types of portfolios, right? And so what we're looking at here is, if I take these ones out, this portfolio is Lifestyle Model 6. So that's the one that's been the best performing portfolio over the course of the last 11 months. And we've seen really positive returns. What we're actually seeing here, and this was COVID. So what we actually saw there is a minus 20.83% return in that month of March that was COVID. When really we didn't know what was going on. The supply chains had stopped and the world was stopping and no one really knew what was happening. We saw a minus 20. And that's because it was so completely exposed to growth. It is so completely exposed to growth assets. Over time, of course, it recovered pretty quickly within sort of what was 6 months or so. It was back to where it was previously. But, it's important to understand that if you bring in, say, the portfolio that's not as exposed to growth assets, so it has a 50% exposure to growth assets and 50% exposure to defensive assets, you see it didn't fall as far. Okay, so it fell by about minus 11 versus minus 20. So that part's pretty important. Any comments, Sam?
I was just going to say the thing that I always kind of talk to clients about too is the pace of return back to like the zero level is usually quite similar. Like, say, for example, during the COVID period, you can see there that the 6 and 3 basically returned back to zero at a very similar point. And if you're looking at it today, 6 is ahead of 3. So it's interesting where you take less risk. Sometimes it can take a little longer to return back to your starting point. So, and again, this is all about your tolerance for these drops. But it's really important to understand when we're talking about time in the market that there will be periods that are difficult and it will feel uncomfortable. But they're the things we need to step into and be aware of and have a greater understanding of, which should help alleviate some of that when we're in it.
Yeah, that's right. And just to your point just then, Chris, so this portfolio is 6, this portfolio is 4, and this portfolio is 3. So I guess, and they've all come off what is essentially the same base at the bottom of COVID, and certainly the same starting base. So you see there's more power in the return on the way up. There's also more power in the return on the way down with more risk in the portfolios. It's interesting, isn't it? If you were to ask someone like maybe someone my son's age, youngest son's age, something like that, which portfolio would you choose? And I'm sure, knowing my son, he would say, well, I'll choose the one that's going to make the most money, Dad. Well, sure, no worries. He's also 9, so but I guess I mean, that's the point. It doesn't look too bad because you're looking at it in the context of the returns come through eventually, right?
Absolutely.
And looking at it in hindsight, but if you're looking at it from this portfolio, which
Yeah,
portfolio did you
correct.
choose, 9-year-old son?
Yep. That's right.
Oh, I don't like to look at this one. So
It's
interesting.
interesting. It is. I was going to say, Cam, if you go back to the growth of 10,000, because it looks all lovely when your investment date's January 2019.
Yeah.
And I'm sure there's probably many clients who are listening or watching to this,
Which is really
and
valid.
you'll have various entry points in here.
Mm.
And I know I've got quite a few who came in at the top of July or the end of 2021, and they've had a pretty average ride over the last couple of years, and there's a sense of what I'm calling investment fatigue or losing heart in the process and feeling like it hasn't worked and they've made bad decisions. And but it's unfortunately it's just a function of what has happened in the markets. But it's always nice to kind of come back and say, well, the portfolio is doing exactly what we said it would do. You'd experience the down, but we'd also get the up. But if we can step back at the 10,000 foot view and say, well, here's the longer term. This is the line we're on. I guess hold steady. The evidence continues to show that the outcomes will be there.
Be patient. Yeah. All right. That's all I had. Is there anything else you wanted to cover off?
I don't think so, Cam. Not at the moment. I think that's pretty solid coverage of what's happening. Really, it's let's just see how the next couple of months plays out in terms of well, the key figures really going to be what's inflation doing and what's GDP doing, and then subsequently the markets will react to that. So
yeah, spot on.
There's not much more really to cover.
Yep. Okay. Look, thanks, Chris. Appreciate that. Final thing from me is obviously the disclaimer. This is clearly general information. It hasn't been. We haven't considered your personal circumstances when we put this together. It may not be a complete description of the matters described. Okay. Well, coming up to the 30th of June, I know I'm personally looking forward to what is going to be a couple of weeks break for me. So we're heading up to the New South Wales coast, which will be wonderful.
That's amazing.
Yeah. So I'm looking forward to that. So I'll be back on deck in the middle of July, ready to get cracking into the rest of the year.
Well, have a great trip.
Thanks, mate. We will.
And we'll
driving holiday with 5 of us.
Well, you did drive across the Nullarbor with everybody and loved it. So
yes,
I'm
that's
sure
true. Yeah.
New South Wales will be easy comparatively to
that. We'll see. No, it'll be good fun. All right. Thanks very much, everyone. Thanks, Chris.
Thanks, everyone.
Have a great night. We'll see you soon.